Here's the brutal truth you probably don't want to hear. Most traders don't blow up because they can't read a chart or because their analysis is wrong. They blow up because their timing is absolutely terrible. You know exactly how this feels, because you've lived this nightmare 100 times. The market opens with a roar. Your analysis from last night says buy. So you jump in. For 30 seconds, you feel like a genius. The price ticks up. Your P&L flashes green. Then the candle wicks down. You're underwater. You watch your account bleed red. You hold, hoping it comes back. It drops further. You panic and sell to save what's left. And the exact second you sell, the price reverses and rips higher, going exactly where you thought it would go. The pain you feel in that moment isn't from being wrong. It's from being right, but getting paid nothing for it. In fact, you paid the market for the privilege of being correct at the wrong time. This is the amateur's tragedy. You're right on direction, but bankrupt on execution. Think about your last losing trade. Really think about it. Was your thesis actually wrong, or did you just enter at the worst possible moment? Did you buy at resistance when you should have waited for the breakout? The market might have eventually moved your way, but your timing was so poor that you got stopped out before you could be proven right. This is the amateur's disease, treating every tick as a call to action. Every candle looks like an opportunity. Every breakout screams, buy me. The amateur lives in constant readiness, finger hovering over the mouse, confusing activity with progress. He believes more trades equal more profit. He's a machine gunner in a dark room, spraying bullets at every shadow, burning through his capital before the real target reveals itself. The professional is different. The professional is a sniper. He doesn't fire at shadows or out of boredom. He waits for proof. He doesn't predict what the market might do. He reacts only when the market confesses its true intent. He might watch a stock for hours, even days, doing absolutely nothing. To the amateur, it looks like missed opportunity. But the professional knows something the amateur doesn't. Patience isn't passive. It's the most active form of discipline. Jesse Livermore understood this better than anyone. A century ago, without computers or algorithms, he built a fortune worth billions today. How? Not by outsmarting the market, but by mastering the pivotal point, the moment when price, volume, and psychology align. He would watch a stock for days, then strike within minutes when the tape revealed its secret. He might see a stock rally to $100, fail, drop to $90, rally to $99, fail again. The amateur is buying at 95, selling at 92, getting chopped up in the noise. Livermore did nothing. He waited for the stock to cross that critical threshold with volume, with conviction. That was the pivotal point. Livermore famously said, "It was never my thinking that made the big money for me. It was always my sitting." Think about that. His analysis was just the prerequisite. The sitting, the discipline to wait for timing to align with analysis, was the edge. Here's the paradox that destroys accounts. The best entries often feel emotionally wrong. They're uncomfortable. They require you to buy when price seems too high, because it's breaking out. They come after long boredom, after the amateur has exhausted his emotional capital. When you feel the urge to trade from boredom, FOMO, or revenge, you're using internal emotional triggers, not external market signals. The market doesn't care about your boredom. It doesn't care that you need to make back yesterday's loss. When you enter based on your internal state rather than market structure, you're gambling. But when you wait for the pivotal point, you're letting the market show you the path of least resistance. You're drafting behind institutional momentum like a cyclist behind a truck. Most traders treat trading like a video game where action equals engagement. But the best traders know that doing nothing is often the highest form of trading. Watching is trading. Waiting is trading. The actual click is just the final step in a long process of disciplined observation. In this video, you'll learn the 1-hour sniper entry method. This isn't a magic indicator, it's a behavioral protocol. We're going to use time as a filter, not a leash. We'll stop you from staring at screens for 8 hours, hypnotized by ticking numbers, making decision after decision until your willpower fatigues and you make a fatal error. You'll learn how to spot Livermore's pivotal point on modern charts using objective criteria, key levels, volume behavior, and price action around those zones. No guessing. No, it feels strong. just repeatable triggers. You'll get a step-by-step protocol you can follow the same way every day. Observation, setup, confirmation, entry, predefined risk, predefined size. No improvisation in the heat of the moment. Most importantly, you'll see the psychological shift that separates the top 10%, accepting that waiting is a position. That doing nothing for 50 minutes so you can act with precision in 10 minutes isn't laziness, it's professional behavior. But first, be honest with yourself. Look at your last 10 losing trades. How many came from clear, planned entries with defined levels and risk? How many came from boredom, FOMO, or revenge? If you're truthful, most of your pain hasn't come from being completely wrong about direction. It's come from entering too early, too late, sizing up too fast, or cutting winners while letting losers run. Your timing and emotional state have been running the show, not your process. From this point forward, every time you feel that urge to click because you're afraid of missing out, remember this: amateurs react to every tick. Professionals wait for the pivotal point. Your job is to decide which side of that line you'll live on. To become that sniper, to stop bleeding money through bad timing, you must first master where and when to act. That journey begins with understanding what a real pivotal point looks like in today's market. Livermore didn't chase every candle. He didn't react to every wiggle on the tape or treat each tick as a call to action. He understood something that separates professionals from the wreckage of amateur accounts. 99% of market activity is just noise. Random variance designed to separate impatient traders from their capital. Livermore waited for the market to reach what he called a pivotal point, a critical level where price action, volume, and psychology converge to reveal the market's true intention. This wasn't mystical intuition. It was observable behavior. The market would telegraph its next move if you had the patience to watch and the discipline not to act until the message was crystal clear. To understand the pivotal point, you have to stop looking at charts as lines and start seeing them as battlefields. Imagine a stock grinding in a tight range between $48 and $50 for several days. This range becomes a graveyard for amateurs, but the professional sees opportunity in the structure itself. Here's what the amateur experiences in this range. He sees the stock at $49 and thinks it's going to $50, so he buys. 2 hours later, it drops to $48.50. Fear kicks in. He sells for a loss. Then he thinks it's breaking down, so he shorts at $48.70. The stock bounces back to $49.20. Panic. He covers for another loss. By the end of the week, he's made 6 trades, paid 12 commissions, and is down 2% despite the stock barely moving. He's trading the noise, not the structure. Every tick feels like a signal. Every minor push or pullback becomes a reason to act. His trading isn't anchored to logic, it's anchored to emotion. The professional looks at the exact same chart and does something radically different. He marks $50 as his line in the sand. Maybe it's a multi-day high, a psychological round number, or a level that aligns with weekly resistance. He chooses that level in advance and makes a decision: this is my battlefield. Until price either breaks and holds above this level or decisively rejects it, I do nothing. That single choice already separates him from 90% of market participants. He's choosing his spot instead of letting the market drag him around. Then one morning, the tape shifts. You can feel something change in the market's rhythm. Volume begins to surge as the session opens. The stock climbs from $49.30 to $49.80 with increasing volume, then pushes through to $50.20. Here's where the amateur gets slaughtered again. He sees the breakout and panics about missing the move. He chases, buying at $50.15 with a market order, terrified of being left behind. But the professional knows something crucial. Breakouts fail more often than they succeed. The market loves to push above a level, trap the eager bulls, then slam back down to crush them. So he waits. He waits for the test that he knows is coming. Inevitably, profit-taking appears. Price drifts back down. 50.15, 50.10, 50.05. The amateur who bought the spike is now underwater, sweating as his position bleeds red. The pullback continues until price touches $50 flat. The old ceiling is now being tested as the new floor. This is the moment of truth. This is where the market confesses its intention. The professional watches three things simultaneously. First, has price reached a logical level? Not just any price, but a level that means something structurally. The high of day, prior swing high, round number, or key support and resistance zone. Random prices don't create pivotal points. Second, did price push through that level, pull back, and hold? The sequence matters. Push, retest, hold. If it pushes and never retests, you missed it. If it pushes, retests, and breaks down, there was no pivotal point. Third, is volume confirming the move? Volume is the fuel. A breakout on light volume is a car trying to climb a hill on fumes. When price touches $50 and holds firm with buyers stepping in to defend the level, when volume stays elevated rather than drying up, when price starts curling back up to 50.10, the market has confessed. It is proven that the path of least resistance is now higher. The ceiling has become the floor. Resistance has become support. That retest and hold at $50 is your pivotal point. Your entry comes at 50.10 after the confirmation. Your stop goes just below the retest low at 49.80. Your risk is 30 cents, but your thesis is validated by structure and behavior, not hope. Compare this to the amateur who bought randomly inside the range at $49. Where's his stop? 48.50? That's 50 cents of risk for $1 of potential reward, a coin flip. The professional entering at the pivotal point risks 30 cents for the same dollar of upside, but more importantly, he's entering at a point where the market has shown its hand. His timing is precise, because his trigger is specific: level, reaction, volume, confirmation. Not opinion, not prediction. Evidence. This is why the pivotal point isn't about being first. Professionals don't get paid for being early. They get paid for being aligned with momentum that's been confirmed by structure. When you wait for the pivotal point, you're trading at the edge of a move that's supported by observable behavior. You're forcing the market to prove itself before you risk capital. The power of this approach is filtration. Most price action is random negotiation between buyers and sellers without clear control. If you respond to every fluctuation, your equity curve becomes that noise, chaotic, unprofitable. By focusing only on pivotal points, you ignore the middle of ranges and act only when the market declares a winner at a key level. This also solves the emotional problem that destroys accounts. When you have clear criteria, you can't trick yourself. Either the pivotal point formed or it didn't. Either the retest held or it didn't. There's no room for hope or fear to override your process. The market either confesses its intention through price and volume behavior, or it doesn't. Your job becomes listening, not guessing. But here's the twist that most traders miss. Even if you can spot the pivotal point perfectly, when you act is just as important as where you act. You can identify the perfect setup and still destroy your account if you're watching screens for 8 hours, exhausting your willpower and making impulsive decisions when your discipline is depleted. The market has a rhythm. A breakout at 10 a.m. is a different animal than one at 12:30 p.m. during the lunch lull. In the next chapter, you'll learn how to compress everything about pivotal points into a single focused 1-hour window each day, so you're not glued to screens all day, so your discipline is forced by the clock, and so you become a sniper instead of a gambler. Here's a paradox you must accept if you want to survive in this market. To improve your entries, you must trade less, not more. This idea feels completely backward to most traders. They believe more screen time equals more opportunity. More opportunity equals more profit. So they sit in front of charts from market open to market close, scanning, analyzing, waiting for something to happen. By lunch, their willpower is depleted. By mid-afternoon, they're making impulsive decisions just to feel productive. By the close, they've made 6 trades when 1 would have been enough. Most traders treat every moment as a potential trading opportunity. Every candle could be the start of something big. Every pullback might be the perfect entry. This mindset turns trading into a slot machine. You pull the lever over and over, hoping this spin is the winner. The professional operates from a completely different framework. He builds what I call time fences, specific windows where trading is allowed, and long spans where observation is the only job. This isn't about limiting opportunity. It's about concentrating focus and preserving discipline. The professional understands that his mental capital is just as finite as his financial capital. He knows that human focus is a limited resource. You cannot maintain peak cognitive performance for 6 hours straight. It's biologically impossible. So instead of trying to catch every move all day long, the professional constructs rigid boundaries around when he's even allowed to trade. The 1-hour sniper window is your new rule, and it's non-negotiable. You're only allowed to enter new positions within a specific 60-minute block each day, and only if a pivotal point triggers during that window. Outside this window, you are forbidden from opening new trades, no matter how tempted you feel. You can manage existing positions, you can journal, you can watch the tape, but you cannot hit buy or sell to open. If no pivotal point forms during your window, you take no trade. If a perfect setup appears outside your window, you let it go. This sounds insane to amateurs. They'll scream about missed opportunities and leaving money on the table. But professionals understand something deeper. Missing trades is part of the game. Overtrading is what kills accounts. Selectivity is survival. For most traders, the optimal sniper window is the first hour after the market opens. This period from 9:30 to 10:30 offers the highest volume, the clearest momentum, and the most reliable follow-through. Institutional money is active. Overnight gaps get resolved. Opening ranges get established and tested. The market reveals its character for the day in this first hour. After 10:30, volume often dries up. Price chops around in tighter ranges. The clarity disappears. The amateur keeps trading through the noise. The professional closes his platform and walks away. Let's break down the 1-hour sniper window into 3 distinct phases, each with a specific mission. The first 15 minutes are observation only. From 9:30 to 9:45, you do absolutely nothing except watch and mark levels. Your hands stay off the mouse. You're not looking for entries, you're gathering intelligence. What was the opening price? Where did the first candle high and low print? What were the key levels from pre-market and the prior day? Is there a gap that needs to be filled? The opening 15 minutes are often the wildest, most volatile period of the day. Spreads are wide, emotions are extreme, and algorithmic noise dominates. Amateurs get chopped to pieces trying to trade this chaos. You're going to let them. You're going to watch them donate their capital while you build your battle plan. During these first 15 minutes, mark your opening range. The high and low of the first few candles become critical levels. These aren't arbitrary. They represent the initial negotiation between buyers and sellers. From minutes 15 to 45, you enter the setup phase. Now you lean forward. You're watching how price behaves around the levels you marked. Is a stock pressing its opening high on increasing volume, or is it getting rejected over and over again? Is the market respecting yesterday's low as support, or slicing through it like it doesn't exist? You're looking for coiling behavior, price compressing, volume building, energy accumulating. Think of a spring being compressed. The tighter it coils, the more explosive the release. During this phase, you're still not trading. You're watching the market prove itself. Does price respect the levels you marked, or does it slice through them like they don't exist? When price approaches a key level, does it hesitate, consolidate, and attract volume, or does it just drift through on low participation? The market is speaking to you through price action and volume. Your job is to listen without the noise of an open position clouding your judgment. Then comes minutes 45 to 60, your confirmation and entry phase. This is the only window where you're allowed to pull the trigger, and only if a pivotal point forms according to your criteria. Price must push through a key level, pull back to retest that level, hold with volume confirmation, and begin to resume the move. Push, retest, hold, resume. If that sequence completes during this 15-minute window, you enter with predefined risk. Your stop is already calculated. Your position size is already determined. There's no thinking, no hesitation, no second guessing. But here's the hardest part of the sniper window, the part that separates the wealthy from the dreamers. If the hour ends and you haven't entered a trade, you walk away. You close the platform. You don't extend the window because you almost found a trade. You don't chase a setup into the lunch hour. You accept that today, the market didn't offer you a high probability opportunity. Amateurs hate this protocol because it forces them to confront their real addiction, the action itself, not the profit. They don't want to trade well, they want to trade often. They want the dopamine hit of clicking buttons and watching numbers move. The 1-hour sniper window removes that drug. You get one focused hour. If your setup appears, you act with precision. If it doesn't, you preserve capital and emotional energy for tomorrow. This protocol is about identity transformation. You're no longer the trader who reacts to every flicker on the screen. You're the sniper who shows up for 1 hour with a clear, repeatable process. You're the professional who understands that selectivity is survival. A sniper doesn't fire his weapon to see what happens. He doesn't fire because he's bored. He sets up, observes, waits for the target to walk into his crosshairs, and takes one shot. In the next chapter, we'll build the complete risk management framework around your sniper entries. Because a perfect entry in your window means nothing if you don't have structure around position sizing, stop losses, and scaling when the market proves you right. A perfect entry with bad risk management is still a bad trade. You can nail the pivotal point with surgical precision, execute flawlessly during your sniper window, and still destroy your account if you treat position sizing like an afterthought. This is where most traders quietly sabotage themselves. They obsess over entries, spend hours studying charts, but when it comes to risk, they wing it. They size positions based on how confident they feel or how much money they want to make. The professional operates from a completely different framework. Before thinking about profit, he decides exactly how much he's willing to lose. Jesse Livermore never bet big at the first touch of a pivotal point. He was aggressive, but never reckless. He understood that even perfect setups fail 30 to 40% of the time, so he would enter what he called a probe position, a small test, to see if the market would confirm his thesis. If the market proved him right through price action and volume, he would add to the position as it moved in his favor. If the market proved him wrong, his loss was manageable. This approach of entering small and scaling into strength is how professionals compound winning trades while keeping losses tight. Let's walk through the complete protocol using a concrete example. Suppose you followed the 1-hour sniper window perfectly. During the setup phase, you're watching a stock that's been grinding near its opening high of $50. At 9:52, volume surges. Price pushes through $50 and climbs to 50.40. The amateur sees this breakout and panics about missing the move. He chases, buying at 50.35 with a market order. You do nothing. You wait for what you know is coming. Price drifts back down on profit-taking. 50.20, 50.10, 50.05. It touches $50 flat, the old resistance now being tested as new support. Volume remains elevated. Buyers step in aggressively. Price holds firm and starts curling back up. This is your pivotal point. The push, retest, hold sequence has completed during your confirmation window. Now you act, but with mathematical precision, not emotional impulse. Before you even think about clicking buy, you define your risk. This is non-negotiable. Where is the logical invalidation point? If this trade thesis is wrong, where will the market prove it? In this case, if price breaks back below the retest low and closes under 49.70, the pivotal point has failed. The breakout was false. Your stop loss sits at 49.70. From your entry at 50.05 to your stop at 49.70, you're risking 35 cents per share. Now comes the calculation that separates professionals from gamblers, position sizing based on account risk, not arbitrary round numbers. You've decided to risk 1% of your account per trade. With a $10,000 account, that's $100 of risk. You divide $100 by 35 cents. Your position size is approximately 285 shares, not 300 because it's a round number, not 500 because you're feeling confident. 285 shares, because that's what the mathematics dictate. But here's where Livermore's genius becomes clear. You don't enter your full position at once. You enter with a probe, half your intended size. You buy 140 shares at 50.05. Your stop remains at 49.70. If you're wrong, and price immediately collapses, you lose about $50, half of your 1% risk allocation. Why split the entry? Because even perfect setups fail. The market might push through, retest, and then collapse anyway. By probing with half size, you're testing whether the market will confirm your thesis before committing full capital. Now you watch the tape. If price immediately breaks down through your stop, you're out with a small, controlled loss. Your discipline saved you from a larger hit. But if the market confirms, if price respects the $50 level and begins building strength, you've earned the right to add. Price climbs to 50.30, then 50.60, then 50.70. Now it pulls back slightly to 50.55 on lighter volume. This is a shallow retest, a higher low. The structure remains intact. Buyers are defending the new level. This is when you add the second half of your position, 145 shares at 50.55. Your average entry across the full 285 shares is now approximately 50.30. Notice what just happened. You pyramided into strength. You bought more shares at a higher price because the market was paying you to increase exposure. This feels wrong to amateurs who love buying things on sale, but professionals understand that higher prices often confirm the trend. When you add that second piece, you also trail your stop loss higher. You might move it to break even on the first lot or to just below the recent higher low at 50.20. Now you have a full-size position, but your actual risk exposure has shrunk. You've built size using the market's money. Here's the golden rule that will save your account. Never add to losers. Amateurs do the opposite of pyramiding. They buy at 50, watch it drop to 49, then buy more to lower their average cost. This isn't value investing, it's account suicide. When a trade moves against you immediately, the market is delivering information. It's saying your timing was off, or your thesis was flawed. To add money to a losing position is to fight the tape. You're trying to impose your will on the market instead of listening to what it's telling you. Livermore had a strict rule. If a trade showed him a loss, he cut it fast. He never averaged down. Averaging down turns manageable losses into catastrophic ones. When you average down, you're adding to hope. When you pyramid up, you're adding to proof. Burn this maxim into your process. Add to proof, not to hope. Your stop loss isn't just a price level. It's a decision boundary. It represents the point where your thesis is invalidated. When price hits 49.70, you don't debate. You don't hope for a bounce. You don't give it more room. You exit. The market has spoken. Your analysis was wrong, or your timing was early. Either way, the trade is over. Professionals treat stops as sacred because they understand that capital preservation is the foundation of long-term survival. Link this back to the sniper window and pivotal points. The tighter and clearer your entry, the smaller your risk and the greater your potential reward. When you enter at a precise retest with a stop just below the invalidation level, you might risk 35 cents to make $2 or more. That's better than 5-to-1 reward to risk. But if you chase the initial breakout at 50.35 with the same stop at 49.70, you're risking 65 cents for the same target. Your reward to risk just collapsed to roughly 3-to-1. Precision in entry directly improves your mathematical edge. This is why the entire system works as an integrated whole. The sniper window forces you to wait for high probability setups. The pivotal point gives you precise entry locations with tight risk. The mathematical position sizing removes emotion from the equation. The pyramiding structure lets you scale into winners while keeping initial exposure small. Every piece reinforces the others. Compare this professional approach to the amateur who bought randomly at 50.35 with no plan. Where's his stop? Probably 48.50, $1.85 of risk. His reward to risk is terrible, and he has no structure for adding or exiting. When the trade moves against him, he'll either panic and sell at the worst moment, or hold and hope while his loss compounds. Your entire identity as a trader shifts when you embrace this protocol. You're no longer gambling on hunches or sizing positions based on how you feel. You're operating from a mathematical framework that's been proven over decades. Before every trade, you know exactly 4 things: where you'll enter, where you'll exit if wrong, how much you'll risk, and under what conditions you'll add. When these are written down in advance, there's nothing left to negotiate with yourself under pressure. In the next chapter, we'll tackle the hardest skill in trading. Not the entry, not the risk management, but the holding. How to set on winning positions without sabotaging yourself. When to exit, and why, after you've done everything right, Doing absolutely nothing often becomes your most profitable decision. Most traders can enter a position. Few can sit with it. This is the great filter that separates the wealthy from the wreckage. You can master chart reading, perfect your timing, nail the pivotal point, and size your risk mathematically, yet still destroy your account because you cannot hold a winning trade. The amateur's curse isn't finding good entries, it's keeping his hands off the mouse once he's in profit. Jesse Livermore's greatest fortunes didn't come from brilliant analysis or constant action. They came from sitting, from holding positions through noise, through pullbacks, through the psychological torture of watching unrealized profits shrink temporarily. He famously said, "It was never my thinking that made the big money for me. It was always my sitting." After the sniper entry and disciplined scaling, the real battle begins. And that battle is entirely psychological. Picture this scenario. You followed the protocol perfectly. You entered at the pivotal point during your sniper window at 50.05. You pyramided into strength at 50.55. Your average entry across 285 shares is 50.30. The stock climbs to 51.20. You're up 90 cents per share, about $257 of unrealized profit. Your brain floods with dopamine. You feel like a genius. Then a red candle appears. Price drops from 51.20 to 51.05 in 30 seconds. $42 vanishes from your P&L in real time. This is where amateurs self-destruct. Fear whispers, take the profit before it disappears. You were up $257, don't let it turn into a loss. Your hand moves toward the mouse. Every instinct screams to close the position and bank the win. But here's what's really happening. You're confusing normal market noise with trend failure. That pullback isn't the trend dying, it's profit-taking, healthy consolidation. The structure hasn't broken. Volume hasn't spiked on the sell-off. No key level has been violated. The amateur exits at 51.05, locking in about $215. He feels relief. 10 minutes later, the stock is at 52.40. He just surrendered another $385 because he couldn't sit through 60 seconds of discomfort. This pattern repeats across his entire career. He catches the first leg of every move, then exits in fear, watching from the sidelines as the real money gets made. Here's the brutal psychology. We often fear winning more than losing. When you're losing, hope takes over. You hold bad trades too long. But when winning, fear dominates. You panic at normal pullbacks. You cut winners to relieve anxiety. This is why amateurs go broke taking small profits and large losses, while professionals get rich taking small losses and massive profits. The professional operates from a completely different framework using a 4-step exit protocol. First, predefine your target before entry. This isn't optional. Your target might be the next resistance level, a measured move, or a multiple of your risk. If you risked 35 cents, maybe your target is $1.40, 4 times your risk. Write this down before you enter. When emotions spike mid-trade, you'll have something concrete to anchor to. Second, read the tape for character change, not price movement. Livermore didn't exit because of one red candle. He watched for fundamental shifts in market behavior. Healthy uptrends show strong moves higher on increasing volume and shallow pullbacks on lighter volume. Weakening trends show failed attempts at new highs with each rally met by heavier selling. You're watching for volume drying up on rallies, repeated failed new highs, or heavy distribution. These are real signals. A single pullback on normal volume is noise. Third, use partial profit taking to manage psychology. When your trade hits 2 times your risk, when you're up 70 cents from your 50-30 average, take half your position off. Bank about $100. Now you're playing with the market's money. Your remaining position can run without triggering the same fear response. This technique quiets the emotional brain while keeping you in the game for the big move. Fourth, trail your stop as the trend progresses. Don't leave your stop at the original level once you're significantly in profit. As price makes higher lows, move your stop just below each new higher low. You're letting the market tell you when the trend is over through structural breaks, not random fear. But here's the deepest lesson. Once you're in a valid trade with proper structure, your job is to not interfere. Doing nothing becomes your most profitable action, Every unnecessary adjustment introduces opportunity for error. The market doesn't care about your comfort. Your edge is staying in when others panic out. You're fighting loss aversion. Losses hurt twice as much as gains feel good. When you're up $257, your brain treats that unrealized profit as yours. When it drops to $215, you feel like you lost $42. You didn't lose anything. You experienced normal variance, but your emotional brain can't distinguish. You're also fighting the need for certainty. Unrealized profit is uncertain. Realized profit is safe in your account. Your brain craves that certainty, even sacrificing much larger uncertain gains. This is why amateurs take small winners and let losses run. Taking the winner provides immediate relief. Holding the loser avoids admitting defeat. The professional accepts uncertainty as the price of large profits. He treats unrealized P&L as information, not emotion. If structure is intact, he sits. If structure breaks, he exits. Your maxim. Your profit is the market paying you to be patient. Let's close the complete loop. The 1-hour sniper entry limits when you act, preserving discipline and mental energy. The pivotal point defines where you act, at levels where the market has proven intention. Risk management and pyramiding govern how much you commit. Probing first, scaling into strength. And waiting determines how long you get paid, sitting through noise, letting the market work for you. Your transformation doesn't come from more indicators or patterns. It comes from more discipline applied to fewer, higher quality trades. Cut losses fast when structure breaks. Size small, and wait for proof before scaling. Trade only during your sniper window. Let patience compound your winners, instead of fear cutting them short. If this resonates, audit your last 20 trades with brutal honesty. How many losses came from entries outside your planned window? How many winners did you cut too early because you couldn't sit through normal pullbacks? That audit will show you exactly where your edge is being leaked. In our next lesson, we'll build the daily routine and journaling process that makes this method automatic, so you're not relying on willpower in the moment, but on systems built during calm preparation.